All right, everybody. In this video, I'm going to be going over another company that was relatively in high demand from commenters. It was a company that posted relatively weak financial results after having a string of a few years where it just absolutely crushed it, and that is Stella-Jones. The company had been on quite a run over the last while, but took a big dip post earnings. But the thing here is the dip is not solely due to the weak earnings. There is a lot of issues around this company based on the fact that the Republican Party won the election. And the reason for that is primarily tariffs. But I'm going to get to that in a bit. First, I'm going to dive into the quarter, my overall thoughts on the company, and then I'm going to kind of give my comments on the forward outlook based on these potential issues Stella could be facing. And as always, everybody, I have a free case study in the description below. I go over a very popular investing strategy here in Canada and how there is possibly a better alternative, kind of open people's eyes to the potential results of both strategies over the last decade or so. That's absolutely free in the description, and it is an absolute must read in my opinion. Many of our readers have stated it's one of the biggest eye openers they've had in their investing careers. So if you don't know what Stella-Jones is, they are a lumber company, but they aren't a lumber company in the sense that they provide a lot of, say, residential lumber, like many of the Canadian lumber producers do. Instead, they operate in a relatively niche environment where they provide things like utility poles, railway ties, things like that. That makes up, 70+% of the business. These two sectors are typically thought of as relatively defensive in nature. I mean, utility poles are a maintenance element, although they are used in new expansion as well, and that's slowing to a degree, and I'll get to that in the quarter. But a lot of utility poles and a lot of railroad ties are going to be purchased just primarily based on routine maintenance. So this company is somewhat sheltered from the high volatility in terms of lumber prices, in terms of housing demand, things like that, because residential lumber only makes up about 18 to 20% of the business. So let's dig right into Stella-Jones's quarter. Now, the company fell quite a bit on earnings. If we go to its stock price here, we can see it was sitting at around $87 pre-earnings, and it dipped down to $70 post-earnings. So that is quite the dip, especially for a company that really doesn't see a ton of volatility. If we look to 5-year price charts here, we can see Stella-Jones, after the COVID-19 pandemic, lumber companies took a big hit in price over this time. In 2022, it was $32 a share. We come up to 2024, it was up to $96 a share. This is a big return from what I would view as a boring lumber company, and overall it's done very well over the last while. So obviously it's gathered interest on this run up, and now many investors are wondering what this dip is all about. Well, when we look to the actual earnings, the company reported a relatively weak quarter. I would say one of its weakest in a very long time. We have revenue of $915 million. That missed expectations by about 9.3%. And when we looked at earnings per share of $1.42, that missed estimates by nearly 20%, 18.6%. So that is no doubt going to cause some worries. It's going to cause some revaluations of the stock price, and this actually was a Stocktrades premium call back in the $30 range, but we ended up removing it at around, I believe it was $67, because we felt the valuation was more than enough at that point in time. The gap had closed. It obviously ran up into the mid 90s and has now dipped back to that $70 level. So a lot of people are wondering if it's back to that value range, which I will get to in a bit, especially regarding the tariffs. But in terms of the quarter, we're looking at a relatively slow quarter from the company. So we look to Q3 2023 revenue of $949 million. That dipped all the way down to $915 million. Now we're looking at year-to-date revenues still being higher. However, the company is showing some weakness now in terms of overall demand for their products, which is ultimately impacting results. We look to Q3 2024 EBITDA of $193 million. That that dipped quite a bit this quarter, down to 162 million. Again, year to date, we're still up, but that quarter over quarter decline is likely going to be scaring a lot of investors that this company is, on the beginning of a drawdown just due to lower overall demand. Now, I'm not going to go over their guidance right now. I'll do that in a bit, but what I want to look at is their overall revenue per segment. If we look at their revenue for utility poles, that increased on a quarter over quarter basis. We can see 448 versus 438 last year. But one of the things with this is demand for utility poles is falling, but they've been more than able to offset that with increasing costs. Now, how much they can increase costs moving forward in the future remains to be seen. They're kind of, muted on the overall demand for utility poles. I would expect it to continue to decline. Capital expenditures from many utilities are falling because of the economic environment. Financing is higher. They're not, financing new projects as much. And as a result, we're seeing a bit of slowing volumes in this regard. When we look to railway ties, 205 million versus 230 million last year. So that's a double-digit dip as well. And the company had mentioned that railway companies, they're not performing as much maintenance right now. And obviously railway ties, there's not a ton of new railway track being built relative to the pre-existing maintenance on old tracks. So for the most part, the railway ties will be tied to the maintenance of these railroad companies. And right now, volumes are declining in that element as well. When we look to residential lumber, and as I said, as you can see, 191 million, it's a relatively small portion of the business. We're seeing, again, declines in that regard. Obviously, with interest rates being higher, there's going to be less consumers doing renovation projects. Housing starts are slowing down. So in that regard, the decline in residential lumber demand is really not all that surprising. But ultimately, all of these declines in the segments and, a small uptick in utility revenue is causing operating income to decline. And another aspect of this is costs are rising while volume is slowing, which is impacting operating margins quite a bit. We can see 17.5% down to 14.2%. So this led to a dip in EBITDA, and ultimately this led to a dip in net income and earnings per share, $1.91 last year down to $1.42 this year. So that is a notable dip in earnings. They're still up year over year, but again, the market is going to be forward looking. This quarter is a bit scary from a volume perspective. The commentary by the company, they stated that, demand is falling in practically every segment, and the only one they've been able to offset the costs on, increase revenue because of higher costs that could offset that lower volume is the utility segment. Now, the one good thing is, and this is a PowerPoint presentation from March, so these numbers have changed a bit, but this is the only presentation that Stella had. Utility poles make up about 47% of total sales. I believe in the most recent quarter, it was closer to 50. So the bulk of the business is going to be from selling utility poles. This is a very niche business. It's not something that a ton of companies do. So there's ultimately higher demand for Stella in this regard. And I mean, we can look to 5-year sales. They've effectively doubled since 2019. And the fact that revenue continues to grow in this segment is certainly a bright spot. But again, those concerns start to come to head. Are they going to be able to continue to increase prices to offset lower demand? That remains to be seen. And also, there is a potential on the decline in interest rates that utility companies do start spending again, do start financing new projects, and ultimately that will drive more revenue in this utility segment. When we go down to their next largest segment, which would be railroad ties, that's around 25% of the total business. Obviously, this is a bit more cyclical. We're seeing, a rise from 2019 to 2020, then a dip, then a rise again. This is going to be the area that is going to potentially struggle moving forward. The railways are not doing very well, and they had stated in the most recent quarter they're seeing lower demand from Class 1 railroads in terms of overall maintenance. So ultimately, this is going to impact the railroad tie segment of the business. And again, as I mentioned, they're a relatively niche lumber company. We see 50%-ish revenue from utility poles, and then we come down and we see 25% from railway ties. So that's, almost 3/4 of the business is coming from these segments. And then when we head down to residential lumber, we're seeing, 19% of total sales. We're seeing a big dip in residential lumber sales. Obviously, the housing market, the renovations, the huge, record low interest rate environment we were in 2021, it caused a lot of new housing starts. It caused a lot of renovations. And we're seeing, residential lumber is posting, it posted its third straight year of declining revenue. And I would expect in 2024, we might see the fourth straight decline. The one good thing again is this company is not primarily focused on residential lumber, so it's not going to be as impacted as other pure play residential lumber companies. Now, I want to get to arguably the most important aspect of Stella-Jones's quarter, and that was not exactly the quarterly results, but it was the Republican Party winning the election. Now, Donald Trump has been known to put some pretty harsh tariffs on imported goods. He's very pro-America. He wants to bring jobs back to America. He wants domestic production. He wants, essentially in Stella-Jones's case, he wants U.S. companies buying from U.S. manufacturers, and Stella-Jones, around 70% of their revenue comes from the United States. And if you'll remember back when Trump was first put into power, his first term, he put a 20% tariff on softwood lumber, which would ultimately no doubt have an impact on Stella. Now, the one thing about it is Stella-Jones, as we can see by the income statement here, I'll go to the income statement, it was relatively unaffected. He put the tariff in, I believe it was in 2017 or 2018, and we can see that revenue, we went from 1.86 billion to 2.12 to 2.18. So, I mean, these tariffs likely had an impact in the fact that revenue remained flat for a few years. And then when we look to, from a net income perspective, we can see 167 million in 2017 to 163 in 2019. So it definitely had an impact on net income as well, but not as drastic as a lot of people had thought. And in 2020, they essentially reduced that tariff down to, I believe it was 9% before he got essentially lost to Joe Biden. So really, the potential for future tariffs from Donald Trump is certainly an issue and is one of the main reasons why I believe Stella-Jones fell as much as it did. It ended up reporting earnings effectively right when the Republicans had won the election. So this was pretty much a double whammy in terms of share price. So, I mean, the election was on November 5th. Stella-Jones reported earnings on November 5th. And, obviously it fell from $87 down to, we're sitting at, just under 70 right now. So what are the potential impacts of those tariffs moving forward? Now, I do believe Stella-Jones might be sheltered a bit from these tariffs just because of how niche the production of the company is. Utility poles and railway ties, they're not exactly a, production that a ton of lumber companies do. Don't get me wrong, there's going to be a lot of U.S. producers that do produce these that, U.S. purchasers might find more valuable purchasing from U.S. companies once tariffs are put in place. But the main area I would expect to be hit by tariffs would be that residential lumber segment, which is ultimately the smallest of the business. But there is no doubt, and I mean, you can tell just by the price, that a lot of people are worried about this potential tariff on this company. Now, the difficulty here is Stella-Jones reported on the 5th. They obviously wouldn't have known who was going to win the election, so ultimately they wouldn't have been able to comment on the potential tariffs in their MD&A or their conference calls, so we don't really have any commentary from the company in regards to this, but it is certainly something you will need to keep an eye on if you're looking at this company at this point in time. Now, the one thing I want to speak about is how strong of a capital allocator Stella-Jones has been over the last while. We can see, we see double-digit returns on invested capital, we see double-digit returns on equity, and one of the things I do want to mention is the buyback activity from the company. So Stella-Jones went through a relatively flat period, a long flat period of flat stock price, and the one thing is back in 2019 they started buying shares back heavily. So they went from 69 million shares outstanding to today we see around 56 million. And you can see that, we go from 67 million shares outstanding to around 59 before the stock price started to really take off. Now, why this is valuable is Stella-Jones is buying back shares at relatively cheap prices. We can see most of these buybacks were made, let's say $45 a share down to, $33 a share. And now the stock price sits at, 70-ish dollars a share. We want to see companies buying back shares when prices are cheap. So if the company does face a lot of pressure in terms of tariffs, in terms of operating results, I could see them initiating stronger buybacks again with the cash flow the company generates. Now, from a valuation perspective, do I feel the valuation gap has opened again? I would say not necessarily. I mean, we have the company trading at trailing 12-month earnings, 5-year median averages 13.85 and 10-year median averages 16.94. So at that point, it does look like quite a big discount to historical averages, but I do believe the market is likely pricing in a lot of difficulties in terms of not only slowing demand, but this tariff element. We don't really know how it's going to work moving forward. We don't know what types of tariffs, if any, he's going to place on softwood lumber. I would say there's a very, very good chance that he does, because the US can manufacture a lot of this, and it's a very easy way for him to encourage domestic production and domestic spending by putting tariffs on softwood lumber. So as a result, I would argue that the company is fairly valued right now, but I don't necessarily think that dip from the $87 mark to the $70 mark is, a slam dunk at this point. When we look to trailing 12-month earnings of 12.2 and we look to forward of 12.1, effectively they're projecting flat earnings for this company. And if we do go to estimates, we can see that they're expected to report earnings this year of $5.48, next year $5.70, and then 2026 $5.70 again. And again, that will likely be a result of that slowing volume in all of its segments, along with the potential for tariffs. So the company did upgrade its outlook, and this will be the final thing that I did go over. They did expect in May 2023, they said they're going to exceed $3.6 billion in organic sales. Now they've kind of updated that to be approximately $3.6 billion in total sales. So that's kind of a downgrade in a way. I mean, approximately means to me that it could come in a little bit lower, it could come in a little bit higher, but everything else has been relatively maintained. They actually boosted their EBITDA margin guidance to above 17%. Previously, it was 16%, and they plan to return over $500 million to shareholders cumulatively from 2023 to 2025, and leverage ratios to remain relatively intact. Now, Stella-Jones here, you can tell, has been a pretty good dividend grower. We're looking 10 years ago, they paid 7 cents a share on a quarterly basis. They've quadrupled that dividend over the last 10 years. Now, do they exercise more buyback activity if the stock keeps tipping down? I would say yes, and I showed you that buyback chart. That is probably a pretty good indicator that the company might be aggressively buying back shares if the price continues to decline. And overall, I think this company will be just fine. They operate, again, in a very niche segment that could actually make tariffs not as big of an impact. But overall, I do think the forward outlook for this company, it's a bit muted right now, and I'm not exactly sure there's a ton of value here, but I also don't think you're paying an outrageous price buying and holding this for the long term at this point in time. So everybody, hope you liked the video. Again, smash that like button, head down below, subscribe to the channel, comment down below. Let me know what stocks you want me to talk about next. And as always, that free case study is in the description. It's a game changer when it comes to your portfolio, and it might completely change the way you invest. And as always, I'll see you next time for more great Canadian content.